Hey, what's up, Market Moose? Mike from the Moose and the Loose. I hope you're doing well today. 8 years ago, I received a big fat check from my previous employer of $108,000. Today, that amount grown up to $318,000. And we're going to see how I did this. I'm going to share with you my 4 golden rules to invest. And we're going to do a deep dive into that portfolio. So what happened is I quit my job at National Bank. I used to be a private banker. So in 2017, I received the value of my pension plan. So I had the option back then to keep the pension plan as is or to receive $108,000. I decided to take the check, but it was not in cash. It was deposited into a locked-in RRSP account, so a Lira account where I cannot add more capital. So the 108 went to 318 just by profit, capital gains, and dividend being reinvested. So if at any time I had $10,000 laying around into any of my accounts, I could not add this capital to my Lira account. So here are some stats as of today. We have annual income of $5,000, $200. Pretty nice. Dividend yield, you're going to tell me it's a bit low at 1.64. That is mostly because the portfolio is growing very fast. My yield on cost right now is 2.71, and it's actually a lot bigger if you consider that I've sold a few stocks throughout the year, because the book value right now on my DSR Pro dashboard shows 193. That means that I made some trades between 2017 and today. And now we have a annualized growth rate as of August 8th of 14.5%. So over the past 8 years, the portfolio grew at an annualized growth rate of 14.5. Is it good? Is it bad? Well, you have to do a benchmark for that, right? So in terms of benchmark, what is really important when you do this is you have to compare with apple to apple, right? So in this case, this is a portfolio that has been 100% invested in stocks all the time. And the good benchmark would be a 50-50 split between the US market and the Canadian market, because this is how I intended to invest my money up front. And over time, I did some trimming. And today we are at 56% in USD and then 44% in Canadian dollars. So pretty much aligned with this. So if I look at 50% investing in XIU, which trades, which follows the S&P TSX 60, and then VFV that will track the S&P 500, but will also factor in currency factor. The benchmark would have given me 13.85%. So 13.85 versus 14.8, it's good. I mean, it's not like flabbergasting, but it's better than nothing because I still beat the index. And the other thing is, I don't do it to beat the market. I do it because it's a lot of fun to invest. I also do it because I love to be in control. And finally, I love to know what I own and why I own it. So because I follow very strict rules, I'm able to actually grow this portfolio, having fun with it. And on top of that, I am in full control of everything. So now, to make sure it's still going to be fun in the coming years, I do have some rules that I follow in my portfolio, and I wanted to share that with you today. So the first one is to have a well-diversified portfolio. So if you're following me on YouTube, you can watch this podcast live where I share my screen of Dividend Stocks Rock. This is the pro account, so I can build all my portfolios, and today I just focused on my pension plan. So when you look at the diversification, well, the first thing that it has to go is between Canadian and USD. As I told you, I aim at having a 50-50 because first, I'm Canadian, so I want still to have some money invested in Canadian companies. It's also protected by currency fluctuation. And then the other half is invested in the US market. Again, I'm not giving you financial advice here. I'm not telling you what to do. The reason why I do it on my side is because I want to have exposure to those great international markets, and some sectors. It's hard to find great performing Canadian stocks in the technology sector, for example. So that's why I go on the US side. In terms of sector allocation, that is super important as well. I do have a big chunk into financials, but when I look into the stocks in this one, it makes sense. So 27% of that portfolio is invested in financial stocks. We have a big chunk in Brookfield Corporation. which is an asset manager. Then we have Visa, that is a payment processor. And of course, I'm Canadian. I have two banks, Royal Bank and National Bank in this portfolio that will close the financial segment. After that, all the other sectors are between 5% and 17%. So we have industrial at 17, we then have information technology at 14, we go down to material at 10. And I'm not a big fan of material, but there you have Stella Jones, that is selling railway ties and utility poles that are more like an industrial stock, in my opinion. And then CCL Industries, that is selling specialty packages, RFID scanners. So you have like a lot of labeling there. Again, more a mix of like consumer and industrial, but because their business model relies a lot on cost of raw materials, it is still considered as a material stock. So as you can see, I'm not fully exposed to one specific industries. Even in the financial one, if there is a banking crisis, for example, I do not have a large portion of my portfolio exposed to this because I have also Visa and Brookfield. And let's be honest, if there's a mortgage crisis in Canada, Visa is not going to feel it, neither is Brookfield. So the key here is to have a great diversification in terms of sector, but also in terms of dividend diversification. So when I look at my dividend diversification, the maximum I have is 11% of my income being produced by National Bank, and most of them goes quickly down to 7 or 8%. So if I suffer from any dividend cut, again, I'll be fully protected. The next thing that I do after having a strong dividend triangle is actually focusing on, the strong diversification is having a strong dividend triangle. So if you're new to the show, the dividend triangle is a combination of three super important metrics. So I focus on revenue growth, earnings per share growth, and dividend growth. As an example, you can look at the graph on YouTube for Microsoft, where you see the 10-year stock card graph provided by Dividend Stocks Rock. You see that the revenue growth over the past 5 years is actually 15%. Then earnings per share is at 19, and then the dividend growth is at 10. So we have a perfect dividend triangle. I'm trying to have as many companies like this as possible. Not always the case, but whenever there's a slump in revenue and earnings, I can see it in the triangle, and then I can analyze the quarterly earnings to understand what really happened there. Now, the third reason why my portfolio has been doing well is I never hesitate to sell my losers. By selling my losers, I do not have a special rule to say, oh, you're down 15%, then you're gone to my portfolio, but I do have specific rules to selling. Throughout times I make mistakes, and unfortunately, mistakes are going to come further as well, because this is the life of an investor. You cannot always be right. So I lost money on companies like Algonquin, on Silogist, on Andrew Peller, and a lot more. But the thing is, by following the golden rules, I'm able to minimize my loss and keep moving forward. So the first one that is super important is actually to focus on the thesis versus the numbers. So whenever the dividend triangle is not working anymore and I have a strong thesis, well, the narrative coming from the numbers is going to tell me a lot more, and therefore I might sell at this point. There's a dividend cut like Algonquin. I sold right away and then I move on. And finally, I want to make sure that my portfolio is not suffering from a high percentage of exposure to one stock. So I already told you about that. Maximum is 10%. As you can see right now, Microsoft is 10% of this portfolio only. So my rule applies across all my portfolios combined. So if I combine all my portfolio using the DSR Pro dashboard, the 10% of Microsoft becomes around 6. So I'm still all good on this one. I don't have to worry about it. The key here is to be able to move quickly, so I do not have those bad reminders of failures in my portfolio. So I don't have that Algonquin line showing that I'm losing money on it. I just sold, I move on, and I focus on the next trade. It makes my investment process easier as well, and then I increase my level of confidence. The last thing I want to tell you here quickly is I let my winners run as much as possible. As you can see on the last column on the on YouTube, You have the gain and losses. So you see that my biggest position, like Microsoft, Visa, Brookfield, Alimentation Couche-Tard, Apple, they're all showing very strong gains. And that's the key. When a business has a strong narrative and a strong dividend triangle, there's no reason for me to sell unless they go too big. So over time, I trimmed some Alimentation Couche-Tard. I did the same thing with Microsoft, and I did the same thing with Apple because I have it in other of my portfolios. But I always keep them running and keep them performing unless at one point there will be a reason for me to sell. But if the stock is up 400%, I'm still going to keep it, and I'm just going to make sure that I'm not too exposed on that portion. One thing that helps me a lot is to follow each of those companies quarterly. So we do have this at DSR where we have a summary of what the CEO says about the latest quarter. I have the link to the press release, and I have also what the analysis at DSR thinks of the latest quarter. If you want to learn how to analyze stocks and analyze quarterly earnings, I have a free webinar on September 18. You can register at moosemarkets.com/webinar, and I'm going to show you how to make sense of a quarterly earnings press release within 15 minutes. It's going to be a lot of fun, and you're going to learn a lot. So moosemarkets.com/webinar. All right, Moose, that's enough for today. We're going to talk again tomorrow, and until then, don't forget to stay invested.